No, thank you everyone for joining today's session, our signature CEO roundtable. And in case you're not able to hear or see us, please put in the chat so we know that it's not audible. But if it is, I'll continue. So I think I would first like to thank our esteemed panelists today who have joined the roundtable. We have Philippe Sigmund. He's the CEO for Bawa. We have also Suzy Ferreira, CEO for Dini. From we also have CEO for Studio, CEO for Oman Development Bank. We have Numan Ansari. He's the MD and CEO for Pak Oman Investment Bank in Pakistan. And we also have Carissa Reiniger, CEO Planning. And all of them are members of the Finance Forum. And what we try and do is bring the chief executives and the leadership from amongst our member base and for topical dialogue to move the thinking forward on especially the areas where we see much more promise in terms of future potential and growth. And Sarah, if you can flip the slide, the top. We have parts of 4 different topics. And the topics we will try to cover today revolve around some of the key emerging trends as we see evolving in the world. So the first is really the role of digital and alternate lenders. We'll focus on that for the first 20 minutes, and then we'll transition into fueling SME growth to create jobs, that being one of the key objectives of the forum. Then we'll transition to enhancing cross-border trade. Again, an emerging trend, not sufficiently leveraged by the industry. And finally, we'll transition into leadership in the AI world. So these are the 4 topics, and we have highly knowledgeable and experienced speakers and experts opining on these 4 matters as we go into the discussion. So we'll kick off the first session, which revolves around the role of digital and alternate lenders. And what the format will follow is we'll have 2 speakers. We'll set the context and we'll bring in 2 discussants who'll add their perspectives with respect to their markets and their experiences. So from that perspective, I think we'll kick off the session with a broader question. And Suzy, I'm going to turn to you for the first question in terms of what is the right balance between banks and digital lenders. You are a digital lender and digital platform yourself. So from that standpoint, what's your experience and view on what should be the right mix between banks and alternate lenders in terms of capital distribution and risk mitigation? So over to you, Suzy, and thank you for joining.
Thank you, Kamar. So very quickly, my name is Suzy Ferreira, founder and CEO at Gini. We are embedded lending player in Brazil. We pioneered this model in the country and actually in the globe as well. We started in 2018, pitching that every platform, every ecosystem can become the bank of the merchant operating into this ecosystem. Back then, embedded lending was not a name, so it was very hard to position ourselves. We were very much getting inspiration from payments industry, how payments became basically invisible, instant, and how every financial product would eventually be transformed in that way. So we saw this opportunity to, instead of building a bank, I was a banker by background, and at a very early stage of my career, I already wanted to build a bank from scratch because I saw so many problems, so many issues, and so many opportunities. And then I thought, instead of building another bank, another new bank, another Revolut, which was the first, like the digital evolution of traditional banks, we imagined how banks would be in this like 10, 20 years sort of time frame. And we realized that instead of trying to build a completely isolated institution, what if we embed, what if we integrate our services in those ecosystems where those small businesses are already operating? So we pitched this idea firstly to the founder of iFood, which was Fabrício back then in Brazil in 2018. And he was like, this is exactly what we're going to. We love this idea. And we started. In 2009, we launched Genie. And to this date, despite the various different crises that we've experienced as a startup, now we're a little bit more matured. And to this date, we continue to pursue that strategy.
Sorry, Susie, I think we lost you. So I think Susie's trying to reconnect, but let's continue the discussion. I think the stage on how the digital lenders, I think how she came into the market. But Philip, let me bring you in here because I think you've also been looking at branch light models, alternate data, and especially in the emerging markets, you've really worked at the bottom of the pyramid space as well. So what's been your experience in terms of leveraging data and any view on the role of digital lenders as well?
Thank you very much, Kamar. Yes, indeed. Well, just to put a bit of context, so I work for Baobab Group. We started 20 years ago as a very traditional brick and mortar microfinance group, purely doing bottom of the pyramid microfinance, but specializing on small businesses. And we've scaled quite significantly, not in terms of number of countries where we operate, but more in terms of size. So we're now focusing on the African continent, and we're one of the biggest players in the space of financing small businesses on the African continent. So still very much, I would say, brick and mortar based, but quite big and market leader in many of the countries where we operate. So now our loan book is around $1 billion in total, and we serve about 600,000 active small businesses, 1.6 million customers in total. And still very much with a branch footprint and so on. But we see clearly that the trend is towards being more digital. We see very significant competition also from some of the purely digital players. Not in all markets, but in some markets like in Nigeria, also in Francophone West Africa. In Nigeria, this is particularly the case with the likes of Moneypoint and this type of players who are very big and who are becoming very active in serving small businesses. So we see this definitely as a very serious competitive threat. But that being said, when you operate in the small business space, I still think that it has a huge advantage of having a footprint on the ground, or to have a presence on the ground, because in very informal markets like in Africa, it's still very much, the business is still relationship based. Even if you start using alternative data and you do scoring on, let's say, repayment behavior, on transaction data and so on, it's still very much relationship based. And this is very important, especially in terms of managing portfolio quality and risks, because most of the lending that we do is unsecured. I mean, that's really what we do, is unsecured, mostly working capital financing for small businesses. And then in terms of, once you have a strong relationship, which is very often a personal relationship with a customer, then it also helps with collections. But at the same time, we clearly see that digital is becoming much more important. So we're trying to think about ways of how to digitize a lot of the credit decisioning. And right now, I would say it's about 50% of our loan disbursements are based on automated credit scoring on certain types of repayment behavior, transactional data, and so on. But we expect that in future it will be more and more just based on credit scoring. So that's the direction where we're going. But at the same time, we think that the branch footprint which we have plays a crucial role, because we are also we want to stay close to the customers. And as I said, these are very, very informal markets. And of course, when you operate in very informal markets, then you don't always have the right quality of the data. So we think that the personal contact with the customer, verification on the ground, visiting the business and so on, still plays a very important role, especially in very informal markets.
Well, thank you, Philippe. And I think you've touched on very important topics: informality, data availability, as well as how the relationship business is still dominant in some of the emerging markets. But Susie, let me turn to you. I hope you're back online. As a digital lender, I just want to build on what you said. You came in as a digital lender. What are the top 2 or 3 lessons you've learned as a digital lender, and how that you feel has promise going forward? Susie, can you hear me? Okay, I think we are still having issues. Sarah, if you can help Susie with the connection. But let me bring you in, Wagner, at this point in time. You've heard the context set by Susie and Philip. I think your space is slightly different. You look at receivable exchanges as well as really transaction data. So I loved for you to build on, especially the whole receivable finance space and alternate data space, especially when it comes to receivables and transaction data. So any light you'd like to share on that? So Wagner, you're on mute. If you can kindly unmute.
Sorry. Morning. Thank you. I think it's important to mention that the way that we are working here in Brazil, just to give a background, we are launching the first exchange for receivables in Brazil. We are going to talk a little bit more about that in the way that the Brazilian regulators are working to create a more safety environment for receivables. But talking about let's say, the credit side and the alternative lenders, I think that as Susie was saying, and also Philip, we see that is a very good opportunity for SMEs to access credit using these alternative lenders. And basically what we see is that by using this technology, the new payment systems and real business data, instead of the traditional balance sheet analysis and collateral, it's a new opportunity for SMEs to access credit, because we understand that the traditional way of providing credit, it's a major restriction for SMEs. And on top of using these alternative data, I think it's important to mention also the easy access that some of these lenders are offering to the SMEs, because they are working together with e-commerce or marketplaces platform and other platforms. They actually are being part of the day-to-day businesses of these SMEs. So the credit is available there, and it's easy and right to access. And this is very important for these customers, not only because they are not that sophisticated, but also because this reduces the cost of acquiring new clients. The other thing is important is the flexibility of having access of this data provide to developing products. So we understand that having access to information like sales velocity, returns and chargebacks, and also seasonality helps in developing different products and to being more flexible in providing not only pricing, but also credit limits for these SMEs. And I think that the solution of the alternative and digital lenders is a very good way for the SMEs to access credit. I think that the biggest challenge would be basically two. One is the flow of information that we understand that is really important for these models, and to make sure that you will continue to receive all this information is something very important for these models. So we understand that in some cases, like we saw here in Brazil, if you establish your model based on the access of a particular information, and somehow the client decides to change the e-commerce platform, for instance, and somehow you are in let's say, flying blind. You don't know exactly what information you are going to get and how you are going to be able to reclaim the money that you already lent. And the other thing is funding itself. We know that some of these models are kind of new and the track record is very small. So we know that investors will need some time to understand and have more confidence in borrowing money using these structures. In lending money using these structures. So I think that from now on, we see the banks providing most of the funding for these new models, and they're working together. So as you were asking, Susie, about the mix of the balance between the traditional and the new ways of providing credit, we think that actually they're going to work together and complement each other instead of just competing, because it's a different way. And if you provide, let's say, a better way to access credit for the SMEs, this will improve also, let's say, the traditional way of accessing credit, because the balance sheets will be healthier and the companies will have, let's say, cheaper access to credit. So I would think that basically it's going to be something that they will work together until the investors are going to get more confidence in providing more funding for these new models.
Thank you, Victor. And you raised a very important point that, it's not just getting data, but continuity of getting that data to feed the models. I think that's a very important element, despite the fact that it does bring cost effectiveness as well as flexibility. But you mentioned about banks and fintechs working together, and I think we've heard from relatively more developed markets where the ecosystem has evolved. And Hussein, I'd like to bring you in here because I think in the market you operate in, I think that is kind of starting off. So where do you see the future of this as a development bank on how the SME credit infrastructure can evolve to bring in fintech partnerships that are impactful? So I'd love to hear your thoughts and any early successes you've seen in this space in your market.
Thank you. Thank
Hussein,
you.
thank you.
Well, thank you very much, Gladys. Thank you everyone for giving me the opportunity to be here. My name is Hussein and I'm the CEO of Development Bank. It's the smallest bank in Oman, but is the only bank who's only focused to fund the SMEs and the micro loans in Oman. So our loan book is almost $1 billion, but we have just raised our capital last year, and we are moving. Hopefully, we should be touching 5 to 7 billion in the next 2 to 3 years. If I go back, as you come on, Oman is no more the same which when you left Oman. Things are moved into totally different arena. Digital, it's becoming it's in our DNA. Yes, the government is a bit slower in getting the data. So the having the right data, availability data, and the restriction on distributing the data it's very limited. But the banks have evolved in a very advanced level. We reached to a level of an eKYC, and we reached to a level that we in the micro loans we are purely database decision making. In the normal SMEs, in the corporates, still in Oman is a relationship based. It's yet to go into scheme based or schematic lending. But in the micro, we all moved completely toward the the program lending, and it's all is getting the data. Now banks like us our operating cost is on a higher side. That's why we started leveraging on the fintechs. We have very limited fintechs. You can count them in your fingers. But what do we do? To reach to the right SMEs and to reach to the SMEs across the country, we started having the relationship with the fintechs. The fintechs are the one we lend to we don't lend to the fintechs directly. We don't take a risk on the fintechs, but we provide funding umbrella to the fintechs so they can lend. They continue lending and they utilize the liquidity given by us for the lending. We own the customer, but we use their platform for getting it. And honestly, to be honest with you, when for the last 2 years, okay, I started 2 different products, 2 different channels. One was lending to fintechs, lending through fintechs, and one was another product. The NPA and the default and the loans with the fintech platforms, it's almost nil. And the reason is it's a completely the scoring model and was built in the platform, it's more into the behavior of the society, it's behavior of the public over there. We managed to even quantify and digitalize the behavior of the lenders, or also the consumers, and we managed to test it. The credit bureau system, which we call it Malaa in Oman, is evolved in a very high advance. There is a lot of data and information. It's connected to the telecom system. It's connected with the legal system of the country. It's even connected with the insurance companies. So it's very much giving us the enough information to test the behavior of the borrower, both the applicant and the shareholders. And it's making us much easy. It making is much easier to take the decision. If a success you want to know about it, it's when we did with one of the food delivery companies in something like Talabat. We as a bank, we cannot, it's not operationally viable for us to give any loan less than $10,000. Okay, but there are some restaurants, there are some vendors or suppliers within under the Talabat platform. They require bridge loans for a week, for $200, for $200, for $700, for even $1,000. These kind of loans, it's actually being offered through these platforms against a fee base, and I don't remember recording any default. The reason is those restaurants and those suppliers are unable to generate revenue without the platform, and they cannot get disconnected from the platform. Like my colleague was highlighting, if they change the e-commerce, in this case, there is a lot of dependency on the e-commerce. That's their business cannot generate the revenue without that. So it's very much relevant for them to remain there. And the payment system is in Oman now, majority of them is coming through the online payment. So the Talabat connect, let's agree, and that's he has to pay it within a week, the loan of $200. They split that receivables over 7 days and from their collection, and they gather it, and there is a proper reconciliation between the both entities. So the payment received by the bank virtually, and then the limit is available for Talabat to lend it to someone else. So such kind of things, it retried. It's yet to be, it's not moved to SME, it's only limited to micro, and we are testing now. And once we have the proper data is available, we may enhance it to SME level.
Well, thank you, Zain. I think you've touched upon three very important topics. One is about data interoperability. Second is about how different models need to work for different segments, and also how an event-driven lending model kind of helps maintain NPLs at. So, and again, thanks for sharing perspectives. And Susie, I'm going to give you the final word on this segment of the discussion, because I think we do want to hear perspectives from you. You've had immense experience in this. I hope your audio video is now all right. So I'm going to turn to you for the final word on the segment.
Perfect. Guys, let me know if it's working. Otherwise, then we kind of give up. But I love the fact that I just came to speak after Hussein, right? Because it's a very similar model what we're operating in Brazil. And I think that's where I was in the previous, when I was making the first comment, is that I do see a role for banks, right? And they do the recycling of money, getting deposits and putting it back into the economy. And I think that's going to continue. But exactly for those operational costs, regulatory costs, all of that can be improved when you're focusing on very micro and small businesses if you operate with a partner, with a fintech partner like ourselves. That's the pitch that we did in Brazil. I think a year and a half ago, we brought the first bank to operate in our model. So historically, we're using credit funds. And then we built the traction. We were able to prove that the concept, very similar to Talabat, we operate with iFood in Brazil. So we acquire the customer, we use all the data, the operational data that we get from the platform. We then reach out to the receivables registration chambers in Brazil, another ton of data and public available data. So it's literally a data business more than a credit business. And then we're able to pre-qualify these clients and eventually to underwrite them. And then we send to the bank the message like this has been approved. The bank funds the loan. but everything else is done by Genie. So we're as a early stage still startup, we've been able to get the trust and the confidence of a bank to lend through our model, and levels of losses are extremely low, like between 3 and 5%. There is still some losses because we do like very early stage businesses. Like if you are a small restaurant operating for 4 months only, we are doing that type of high risk business. But at the end, it also, the risk reward equation also works for us, and we're able to support business that are just starting, which is very much our mission, right? Because, you know, like startups like ourselves have access to venture capital, but these small restaurants, they don't. They have to borrow money with loan sharks or use their credit cards or overdrafts. So by giving them that early start, that early start capital, I think it's a massive promotion of businesses in Brazil. And yes, so far I sit this day with the bank, with the owner of the bank, which is amazing. It's a medium-sized bank in Brazil. He's looking at the growth, he's looking at the performance, and he's thinking, let's grow, let's continue to do. So now our next challenge is, how do I explain to this bank that I also need some sort of diversity? You know, eventually we want to become like our investor, Paytm. They have, you know, portfolio on the billions, and they have a diversity of banks that are trusting their structure, trusting their models, trusting their data. And now they have, like, I don't know, banks on the 10s or 20s, like top banks in India are using Paytm infrastructure. That's the same thing we want to do in Brazil. And that only works because we have this differentiated model for customer acquisition, but also data. So yeah, it's a great business proving concept in Brazil to enable more banks to join us.
Wow, Susie, this is fantastic, and thank you for sharing. I remember it's a data business, not just a financing business. And I think you've kind of set the context very well for the next round of our discussion when you talk about investment matching, because I think you do need to ground investments, whether you're a fintech or an SME. And from that standpoint, Numan, I'm going to bring you in to really talk about how catalytical capital and again SME development and investment matching needs to happen in some of the emerging markets. So Numan, over to you, and love to hear your experiences from an investment matching standpoint.
Thank you. Thank you, Kamar, and good evening from Karachi. I'll just set up a perspective. I'll just give you a perspective as far as the Pakistan SME space is concerned so that everyone understands properly. So Pakistan's economy, 40% of Pakistan's GDP is contributed by SMEs. There are about 7 million odd SMEs in Pakistan. And I think the last data that I had was of last year, 2025. Out of 7 million odd SMEs, only about 300,000 SMEs have access to credit or capital from the financial sector, which is obviously, which is a huge problem. Even in exports, SMEs contribute about maybe 20-25% of our exports. So, and the trend has been declining in terms of financing to SMEs, access to credit and capital to SMEs has been declining instead of actually improving or increasing. And there are lots of reasons for that, but I think the main reason, I think, is very common in terms of what I've heard other participants say in similar markets or somewhat similar markets. So the issue is not of liquidity. It's basically, and it's definitely not of the demand side, because there's a lot of demand for credit and capital from SMEs. But basically, the issue is that these SMEs are very small, unorganized. Their financial records are weak. Their productivity is low. The linkage to formal, supply chain and exports markets is very limited. So as a result, economically, they're economically active, but not financeable from a lot of commercial banks' perspective. So basically, so this is basically a bit of a North Star challenge for Pakistan, because the opportunity is great, but then so are basically the challenges. So from a catalytic capital, I think obviously there are a lot of developmental firms, finance firms in Pakistan, which are basically making catalytic capital available. And the way it basically works is that you take the first risk where commercial banks are not comfortable in terms of lending. So if you take the first loss or first loss risk, it enables SME financing without excessive reliance on hard collateral or shifting and in terms of documentation. It basically focuses on cash flow performance. And it also supports first-time underbanked SMEs, right? So helping them enter the formal credit market. And if you do that, then I think over a period of time, SMEs, they graduate to a fully commercial financing kind of a structure where banks can actually step in and finance these SMEs. So it's it's the first step which most SMEs find very difficult in terms of getting access to capital. And the reasons are very simple. I mean, they don't have documentation, they don't have financial records. Pakistan is an economy which is basically cash denominated, and so on and so forth. So the kind of products that Pak Oman is trying to use in collaboration with other financing institutions is basically first loss or risk sharing facilities in combination with banks if possible, partial credit guarantees, longer term SME financing, especially with grace periods. I think what really works is supply chain financing, where we basically have the entire ecosystem present through technology. So we have the anchors available, we have the SMEs in terms of vendors or distributors or suppliers available. Export financing is also something which makes a lot of sense, because we know the cash flows, we know the trades, we know the orders from offshore suppliers. Co-financing structures, I think they are getting a lot more popularity in Pakistan because of the need. Basically, the thing is that obviously the opportunity available is great. The problem is, how do basically lenders lend to SMEs without in a risk mitigated way? And I've found that if you, as a lender, embed yourself in the value chains and supply chains. If you embed yourself, then you really understand, because any SME will have some sort of a relationship or some sort of a structure. Will be supplying to corporates, will be distributing. Farmers, as far as I'm concerned, the last time we talked, I mean, there are lots of farmers which don't have capital available, okay? So, for example, if they're farmers who are selling sugarcane, okay, you start from basically onboarding them using technology through an app, and then you finance their cane purchase receipts. So basically, is they're selling sugar cane to a sugar manufacturer, an exporter. So you understand you understand the farmer's behavior, you understand their needs, and you also try and cut out the sharks in the market, where basically they charge exorbitant rates really from the farmers. So it's basically technology. You embed yourself in the entire value chain and the entire supply chain. That basically promotes visibility, and that also actually allows you to to build capacity as far as these SMEs are concerned or farmers are concerned. Because building capacity is very, very important. I mean, these guys don't know about documentation, they don't know about onboarding, they don't know about KYC, all these formalities, or not formalities, but risks that financing institutions have to mitigate and face. But so it's a bit difficult. Obviously, it's a challenge, but the opportunity is just unbelievable. Can you imagine 7 million small to medium-sized enterprises which don't have access to capital? They only basically have access to capital through market sharks or shark lenders. And the challenge is to replace them through risk mitigated structures, and also matching their cash flows and their needs, and and obviously an affordable interest rate or pricing.
Thank you, Naman. And when you mentioned capacity building, I could see Caressa nodding, so I'm going to come to her very, very soon, because I think they've done extensive stuff on this. But before I do that, since we heard a perspective from Development Bank in Pakistan, Hussein, you run a development bank in Oman. And I just want to hear from you, what is the importance of a national strategy, a national agenda on SME finance, and how you've seen that work to trigger some of the aspects Oman has touched upon?
Uh, to be honest, the SME in Oman was never thought of. If you remember when we were in the banking together, Kamar, it was just a unit within the corporate banking. It was looked at from a totally different aspect. It's a completely negligent place, and it was just a potential to grow the book. Nothing, no strategy, no proper national mandate. So from 2013 in Oman, there was a government mandate came in that the banks and the lenders should have X percentage of their book to be for the SMEs. That's where the SME lending and the focus has picked up from the country. It was not only from the banking industry, it was late, it was a bit late, 2013, but still it started where the government started looking at building the infrastructure within the country, boosting, realized the importance of SME for job creation, for the GDP contribution and for self-sufficiency and for so on, whatever it is. Uh, it started and is gradually uplifted. It started to be from and then impose, to be very transparent. The government was imposing on the private sector, on the large corporates, on the banks to serve SME, but there was a big gap in the vacuum on the capability of SMEs and the scaling up to level to serve, to be a bankable SMEs from the banking industry, even from the contracting side. They were not able to, meet the expectation of the large corporates and from the distribution. So those, over the last 13 years, we have seen the government worked on to build the national strategy on SME, have giving it a very special seat in the cabinet. It's a full authority was established within the government. We call it Public Authority for SME Development, and who's chairing it is almost a minister level person. Okay, so that much of importance was given. It's an SME was built in every tender being slotted. Oman is still, the entire economy of Oman is still dependent on the government expenditure more than being the self-funded from the large corporate. But still, within the government expenditure, there is a clear ICV mainly for related to the SMEs were given within that. And if you look at it, 5% of each bank in Oman need to lend to SME. So that percentage it's not a small amount. If you take only my largest bank in the country, which is a bank Muscat, it's a 10 billion Omani Riyal book, kind of that itself they need to do a 500 million Omani Riyal, which is almost, you can take the math how many billions of dollars we are talking about a single bank needs to achieve. And guess what? They're almost reaching to that level. And SME in Oman, it's not that large ticket. And SME in Oman is the companies who only have 100 employees and with a turnover not exceeding 5 million Omani Riyal, which is, you can take it as a hardly, less than $20 million as a turnover. So, those kind of national mandates, you can tell them at the strategies, built, imposed, whatever you're going to call them, but that's how the government is pushing. And it worked well, to be honest. Okay, it's working well. There is a focus is coming on these SMEs, and maybe I'll be very transparent. SMEs not yet managed to be a source of creating jobs. Government remain to be the source of creating jobs yet, but SME managed to bridge the self-sufficiency gap within the country. The self-sufficiency, the food security, part is covered well by the SMEs. I would not say 100%, but the majority is done by the local companies. So there are some quick wins within the mandates of the country. SME is already covering. Job creation, I think there is still some lack, Kamar, to be honest, in the banking industry. SME employees working under SMEs are not getting the minimum banking benefits like a car loan, housing loan, personal loan, credit card. They don't get it due to the appetite gap, which makes it still challenging. But national initiatives are a lot. Giving you an example, the bank where I head, it's 91% SME loans, and it's fully 100% government owned. It's subsidized. We charge the lowest interest in the country. We take the highest risk. We take the greenfield projects, and we don't pay dividend to anyone. Whatever money we make, it's all for our sustainability. And when I'm talking to you, I'm talking about a $1.3 billion of a capital bank. So that kind of initiatives are done from the government to boost the SME, from the lending, funding, and to contribute toward the GDP.
Thank you, Sen. And I mean, that's great to hear the national agenda. And recently there was a meeting in South Africa of SME ministers around the world, about more than 50 of them. So I think I see this evolving, but capacity building has been one of the big issues. Carissa, and you also co-chair our non-financial services innovation hub. So I think capability is a question frequently asked, and love to hear what you've seen and how you can even leverage that to scale SME lending. So thanks for joining, Carissa. Over to you.
Thank you. Thank you so much. And hi, everybody. So as everyone was talking, I just would say, I agree with everything. I started Silver Lining 20 years ago and have been living and sleeping and breathing all of these small business issues. And as everyone was talking, I was struck by the irony of a supply and demand issue. There is enough supply, there's enough money, there's capacity to lend to small businesses, and there is enough demand. Every small business owner you talk to in the world wants a loan, wants money. And so as an industry, reconciling, if we have enough supply and we have enough demand, but we're still not able to get these transactions done, what is going on, right? What's the root issue? And there's so much great innovation in this room already, but I think there's really two things, and they both speak, I think, to capacity building. One is how we assess credit worthiness. I love the conversations about alternative sources of data, looking differently at how we assess if a small business owner is ready for a loan. That's something we've been playing with a lot, and I'll kind of come back to that in a second. The other is if the small business is ready for that capital. And I think that's the issue that everyone I talk to in the small business industry keeps coming back to and running up against. They need the money, I have the money, but I can't be confident they're ready for the money, or I don't know how to be confident they are. My background's in behavior change science and psychology, and so we've built a SaaS platform that is digital with deep human support created through it. But our goal is to use behavior modification and behavior change science to help small business owners learn the skill of setting and hitting financial goals, of building profitable and sustainable small businesses. And as we teach the businesses we work with globally in 80 countries around the world, if you are driving good revenue as your primary source of capital, then you either can become less urgently, critically reliant on debt. So you're not going to debt in a crisis. You're going to debt as a way to grow your business, which means that you're going to be better stewards of that debt. You're going to repay it back better. Or you may not need the debt at all. But what we've learned about capacity building, and this is, I think, the conundrum that our whole industry is going to have to reconcile, is that what we see is that lenders are giving small businesses loans or trying to give small businesses loans at scale, digitizing everything and hoping that AI and digital tools will solve for scale. But the reality is small business owners are still humans. And just like every single one of us probably had years of development and people that invested in us and all sorts of, space to make mistakes and come back and keep going. These small business owners don't have that advantage. And so I think there is a deeply flawed and deeply unfortunate reality, which is that we're never going to build a simple digital tool that's going to train every small business how to have financial literacy and then be loan ready. The work of building capacity in a small business owner is actually quite comprehensive. It takes a long time. It's an investment. But the conversations that I think are happening around public-private partnerships, the role of government and banks and fintechs all coming together, I do think that there are national strategies where an investment in the small business economy is really that, literally. And it's not just about putting money into funds and lending to them, but it's making sure that the small businesses across each country, around the world, have adequate structure and support, adequate, technical assistance, for lack of a better word, to succeed. So I think that the reason why we're struggling when there is enough supply and there is enough demand, it is this non-financial service part of it. I don't necessarily think a new debt product is going to solve that issue. It's what are the ways that we need to be more thoughtful, maybe more strategic, and maybe actually more heavily invested in helping small business owners get the capacity building that will actually work. And the last thing I'll say about this is that as an industry, we spend billions, literally billions of dollars a year running training programs and mentorship programs for small businesses, where we do a classroom event and we teach a small business owner for 3 hours how to read a P&L, and then we send them on their way, and then we're frustrated that they didn't become more successful or they didn't become better job creators. None of us would magically learn how to grow a business in a 2-hour workshop in a classroom. That's not going to work. And so we actually are spending enough money as an industry to do capacity building well. We're just not spending it right. And I think if we overhauled technical assistance and we overhauled capacity building, we would solve that supply and demand issue. And all of a sudden, we would see, utilization of the capital that's available, the repayment of it, and the ripple effect of that in the economy.
Thanks, Chris. I think it's very enlightening to hear we're spending a lot, but not spending it right.
Yeah.
And I think that's a very important insight. How do we redirect that? And I think also you touched upon SME investment readiness. And Wagner, I do want to bring you in. I think you've had experiences in that space. So any perspectives on how you build an SME investment readiness and what you've seen work well?
Thank you, Kamar. I think that one of the biggest challenge for us here is that if you go to emerging markets, the financial literacy is pretty low, not only from business managers, but also from the whole population. So it's even harder when you're bringing credit instruments and different credit instruments all the time, especially the owners. They don't have enough knowledge, not only to have, let's say, a proper cash flow analysis, and they don't have management tools, and they don't know how to use these tools. I've been joining some seminars with, let's say, not that small businessmen. They are running companies, they are revenue like $50, $100 million per year, and they lack knowledge of simple instruments to manage the company. So they're very good in their businesses. They're not very good in running a business. So the biggest challenge here is how you can address this in the short term. I totally agree with Carissa regarding to training. We need to invest. We need to help these companies to succeed. But it's something that we understand that is not going to have a short-term result as well. So I think that the idea of embedding the solutions in their day-to-day businesses, like what Susie was saying in Dini, is something that will help, because they don't need to understand that much how the credit instrument works. They don't have to learn that much about accounting or whatever. They just have access to the capital when they need it. So I think that this alternative solutions for credit is pretty important for that. And I think that it's part of our job as well to try to make these credit instruments more easy to access and simple to understand, because it seems like most of the times the products are designed around investor requirements rather than the business needs. And this is something that we should focus on as well. I think that the technical assistant is something that we see some movements here in Brazil, for instance, advisors and the kind of CFO as a service models that will help to bring some of these best practices to the companies. But again, it's part of our responsibility here to make sure that we are creating products that are simple to explain, to match with the company's needs, and to bring these long-term investments on training for these companies.
Thank you, Wagner. We'd love to learn more about the CFO as a service model. I think very interesting. And I know, Carissa, you run programs which embed training into the businesses. I think we'll perhaps come back to it, but I think very good points. And I do want to shift gears a little bit here. I do feel a lot of SMEs remain domestic to some extent, even within their own jurisdictions. And I think there is a need to open markets for SMEs. And Philip, I know you've worked across several markets, and I'd love to hear your thoughts on how you enable trade for SMEs to trade across the borders beyond their traditional markets. Any experience you've gained in supporting SMEs?
Thank you very much, Kamar. I must say that, in my current role at Baobab, I'm maybe not the best placed person to talk about trade finance. But we do some trade finance in some of the markets where we operate. And this is with obviously not with micro entrepreneurs, but with slightly larger SMEs. But I did quite a bit of trade finance in my previous career when I was working for Equity Bank in Nairobi, where we had a very big trade finance desk, and we were supporting a lot of SMEs, not only in Kenya but across East and Central Africa. And indeed, I see a few very important topics that create barriers. And one thing that I see is, and I think this is common knowledge, is that compliance across the world is becoming stricter. And as compliance requirements are becoming stricter, some SMEs are in a way also finding it more difficult to participate in trading operations, simply because they don't necessarily get the right trade finance support from the banks. What colleagues have been telling me also on the ground is that there's a bit of a disconnect between various trade corridors, so it's becoming almost a bit political. But on the one hand, you have OECD countries where trade finance is extremely developed, and then you have more the frontier markets, which are African countries, maybe some countries in Latin America, but maybe less Latin America. The real frontier markets nowadays are in Africa, and which are trading a lot with other BRIC countries, like with China and India in particular. And these are new trade corridors, and the traditional instruments are not necessarily supportive of these new trade corridors. So one needs to think very carefully how to address these issues around compliance, identification. It's very often proof of transaction, proof of documentation, and this kind of things. And one project which is actually very good, and I don't know if anyone here in this is from IFC, but IFC has a very good program, and the Global Trade Facilitation Program, and I think it should be expanded further. So I think this is something that could be done, definitely, because it really comes down to, let's say, fixing the basics around compliance, proof of documentation, and so on, convincing banks to take the risk of financing transactions, even if sometimes from a purely compliance perspective is sometimes a bit complicated, but without taking unnecessary risks, obviously. Then of course, in future, maybe with some digital solutions, it could help to make the system more transparent, to better trace transactions, have better digital registries, better customer identification. That could certainly help. But I think that particularly for Africa, it's important to first fix the basics. So that's, and then I think that obviously it will help significantly. It's not only about trade with the usual corridors like India and China, but it's also within the African continent itself. I think their SMEs could play a very important role.
And thank you for your comment at the chat. Of course, I think hand-holding is essential, and Carissa, for one, will definitely agree. But Philip, thank you for highlighting the need for compliance the importance of understanding trade corridors and also really building non-traditional instruments as suitable for enabling. But I do want to bring Wagner back to you. You've been very heavily into the trade finance space in your markets. So any views you'd like to share on how you stimulate trade activity for SMEs?
Okay, so I think that the biggest challenge here, Kamar, is that we were discussing till now the difficult access to credit for SMEs. And if you consider the let's say, cross-border trades, that will definitely increase the need for credit because let's say the payment periods and the negotiation take a lot longer than the local market. So I think it's very challenging for SMEs to try to access this market, and the flow of information is even harder. And I just would like to bring some of the insights regarding to what we see here in the Brazilian market regarding to receivables trading, because we understand that providing credit to SMEs, it's going to be hard because of all this lack of information, capacity, and also collateral. So I think that we must look at the different alternatives, and this is something that we at Seu Ativo were trying to bring here, is that we should first look at the assets that SMEs are holding in their balance sheets. That could be a source of capital. So we're looking at the receivables and how we can provide more safety for the receivables to allow them to be more liquid. So if you look at the way the Brazilian regulators are working, they are creating here environment where the receivables are going to be a lot safer. And because of that, we believe that we are going to be able to trade these receivables directly with final investors. So instead of borrowing money, the SMEs will be able to make money selling an asset they don't need to carry. So I think that when we're talking about cross-border trades, maybe the solution would be to bring something like that to the international market, because instead of having to wait the payment or trying to borrow money using these documents or this information, maybe the SMEs could just simply sell their receivables to final investors. So if you look at the Brazilian structure, as I mentioned, I think there are three major points that are allowing the assets, the receivables, to become very liquid assets. First is the validity of the receivable. So here in Brazil, invoices are digitally issued, time-stamped and tax validated, creating a reliable source of truth for the underlying commercial transaction. So you can confirm and make sure that there's a real transaction behind that particular receivable. The other thing is the uniqueness and title of the receivable, because we have a registration of the receivable in authorized registries that will clarify the ownership and prevents any double pledging of the receivable. And the third thing is the settlement payment process, where the process is linked to the registry, so the cash is routed automatically to the holder of the receivables, reducing leakage and operational risk. I think that this combination of validity, uniqueness, and control settlement will help transforming the receivables into scalable financiable asset class for SMEs. If you look at the cross-border, I think that even having all this digitalization process, we still see four structural gaps in this process. The verification of validity for trade, cross-border trades, is going to be a lot harder. How you're going to confirm if the invoice is authentic, if you have any undisputed and evidence of the performance. The second point, again, is going to be the uniqueness and title of the receivable. You don't have, let's say, a cross-border registry structure to prevent the double pledging or any kind of fraud. The third thing would be the settlement assurance, the payment of this, let's say, receivables. So you need to make sure that they are certain and you have the right structure to collect and transfer all this money. And the fourth gap, I think it will be the legal enforceability, because not only the compliance things that Philip was mentioning, but also effects and tariffs restrictions, the conflict of laws is going to be a difficult process to allow this, let's say, cross-border receivables to have the same kind of liquidity. But we see there are some opportunities to work on that sense. The first would be the tokenization and securitization of these receivables. Basically, what you are going to do is that you are going to have an issuer of the token that is going to be taking care of most of these details, the performance, the authenticity of the receivable, authenticity of the receivable, also to control the payment and everything. This will add, let's say, an additional risk that is represented by the issuer of the token, but might increase some liquidity for these instruments. The second idea would be to create a kind of regional or sector-based structures where you try to bring some more standard procedures for a particular segment of the market, and then you can address some of the problems in disputes or delivery evidence, and also the settlement of the payments. And the third alternative would be to try to interconnect national registries and payment rails like we have, for instance, here in Brazil and in India. That basically would be a way to try to put together different structures and based on that create, let's say, a more safer process of confirming, of transferring and registering these receivables. I think that the challenge here is to try to create a structure that would not price out the SMEs, because it cannot be that, let's say, sophisticated or complex. Otherwise, it won't fit the tickets that normally the SMEs will be able to trade. And even if we address all these problems, I think that there's another problem. There is how you can put together or connect the participants in these markets, because you can have all the structure in place, but again, you need to make sure that you have the companies that accessing the investors or the investors accessing the companies. And this is exactly what we are doing here in Brazil. So basically, we created this marketplace that will put together the companies that are selling the receivables with the investors that are willing to buy the receivables. So I think that this is how we are going to address not the credit itself, but the access to capital, that we think it could be also a different way of providing capital for the SMEs to growth and generate jobs.
Thank you, Wagner, and thank you for highlighting the three very important aspects: the validity, the title, and the settlement process, and also the importance of marketplaces. Love to build on it further. We've recently started an innovation hub pilot on tokenization of receivables, and how you leverage that in a deep tier supply chain. But I think I do want to bring in, Numan for final comments before we transition to the final segment, which is AI. So Numan, very briefly, I think I just want to hear from you on the whole trade aspect, because for Pakistan, trade and export is a key priority. So any light you'll share on this topic, please?
The problem with trade and access to trade facilities in Pakistan for SMEs is that most of the trade structures are built for corporates. I mean, they're centered around large corporate requirements in terms of letters of credit, guarantees, whatever. The problem with SMEs is that they are increasingly now being linked to global supply chains or regional supply chains, but they lack the capacity. They lack the capacity of mitigating risks, like, for example, FX risk, settlement risk, counterparty risk. So I think I think banks and other players need to basically focus more on SME needs, which are very distinct and different from what large corporate trade needs are. But I think the main problem is that they get locked out of cross-border trade because counterparties can't really verify who they are. A lot of times. So who controls them, who owns them, and whether they can be paid safely in terms of KYB, KYC requirements and compliance requirements. So a minimum trust stack is what I call has to be layered and developed. So you talk about foundational identity, verified individual, for example, behind the business. Who is it? Pakistan's no, like for example, ID infrastructure makes this a lot easier. Verified business registration, for example, NTN in Pakistan, national tax number, gradually, obviously, but it is very important. Operational identity is also very important. For example, a verified bank account and standardized KYB package, I think can make a lot of difference. For trade and network identity, LEI becomes very valuable. When firms are doing regular cross-border transactions, joining multi-bank platforms using structured trade finance, right? Or supplying, multinational or large buyers. So, these are some of the things that I think we are focusing on, and a lot of other banks are focusing on, which are focused on SME cross-border trade and also, helping them finance them. So, basically, the focus should be fulfilling the needs of SMEs as opposed to, and it's going to happen over a period of time. Obviously, it can't happen because all the trade structures, as I said, are built around large corporates. I think one of the things that we've tried in Pakistan, and I think it's worked quite a bit, is also how we deal with SMEs in terms of clusters. Because it's very difficult to, for example, deal with SMEs on an individual basis. It's not it's not practical. It's not, it's not feasible, commercially feasible. So, for example, a lot of these SMEs are export oriented, but they are maybe concentrated in some geographies or sectors. Okay, maybe it could be apparel, it could be textiles, it could be light engineering. So when you talk about clusters in terms of geography and sectors, you identify problems which can be fixed on a group basis. Through various, local business chambers and so on and so forth. And I think that makes a lot of difference. As I mentioned, if we have the entire chain available, in terms of these clusters or sectors or geographies, so we can basically map the cash flows. We can really clearly see where the cash flows are going in terms of this business activity of these SMEs is concerned. Then you can basically help them through what I've just described in terms of making them bankable or making them really known from a trade finance perspective.
Thank you, Naman. I think especially you touched on a very important topic of ID. And I think we've been working with a few institutions on like global legal identifier and also universal trusted credentials, on really how do you create that identity. And secondly, on the sector focus, I think very important on how you approach this as we go forward. And I think this brings us now to the final segment. I think we've touched on three very important topics, but AI is the elephant in the room right now in terms of how AI is going to transform, change, hurt, or benefit the SMEs. And Carissa, I'm going to start with you of the leadership in the AI world. What do institutions like yourselves and the industry needs to do to have an AI-enabled transformation for SME growth?
Thank you. Just the easy question, right, Kamar? What do we all do about AI? So we have a tech-enabled, data-driven SaaS platform that's based in behavior change science, and as we always say, is deeply human. And so we've thought a lot about how do we tackle the ongoing issues of all of the things we want to talk about. How do you help as many small businesses as possible, but give them comprehensive enough support that it actually makes a change, that it actually allows them to optimize their behavior and get different results? And we've really landed on, of course, we're going to use AI. AI is not the answer to all these problems, but if we use it well, it can be a tool to hopefully accelerate all of our ability to solve these problems. And so my personal approach to trying to lead Silver Lining through this age of AI, and what we talk about a lot at Silver Lining with the small businesses we work with, is what I would kind of boil it down to 3 key principles around AI. So one, it's moving fast, so we need to be fast. Any old rules we had about development cycles or design cycles have to go out the window, because if we want to use it, we need to actually be on top of it. So we are putting, I would say, a significant amount of time and money and energy into having our own innovation labs, our own dev cycles. We're looking at dividing our dev teams between a sort of AI and engagement track and just a business as usual track. Like, what does it mean to understand that the pace of things has changed, and how do we maybe abandon what used to work and be innovative and open enough that we change how we operate now that this is part of the equation. The second thing is that we're doubling down on being deeply human. We have made the very clear decision that AI will not replace the human support we give small businesses. We've not laid one person off at Silver Lining in the midst of all the layoffs happening globally. We've laid 0 people off because we believe that, or I believe that if we're smart about it, AI can help us be better at what we do. And if we're really smart about it, it can help our staff have better jobs. It can actually make our team more effective. And so all of a sudden now, with the same team and the same infrastructure, but AI infused through it, we can be better at our work and we can do more of it. And so, yes, we can expand and scale because of it, but not at the expense of the human element, hopefully to empower and embolden and advance the human element. The third thing we're thinking a lot about is that for a small business owner, we're talking and surveying our global small business community constantly. We have small businesses in 80 countries, every continent except for Antarctica. It's a very diverse group of small businesses. They're micro and small, so solopreneurs, under 5 employees, in every industry you can imagine, creatives, farmers, manufacturing, accountants, professional services, kind of all the regular suspects in micro and small business. And what we found is that a year ago, they were really excited about AI. They sort of had these, what I call hopes, wishes, prayers, and dreams that AI was going to solve all their problems. And in recent surveys, they are like a little bit burnt out by it and a little frustrated that they're spending all this time trying to learn it. And it's just another thing on their plate. And so when I think about our role as leaders in the small business industry, I think we have a big responsibility to acknowledge that the average small business's biggest issue is actually not money, it's time. Money to some degree is a infinite resource. There is money out there and we all just need to get better at figuring out how to move it, through the economy. But time is finite. And so what we see is that small business owners are spending a lot of time trying to figure AI out as opposed to sort of getting to the place where it's adding time back to their plate. Now, it's all relatively new in the grand scheme of things. And so I think we'll arrive at that outcome. But what we're trying to figure out is how to help our small businesses leverage the AI features we're building through our platform. And we're trying to figure out how to not just like launch AI for the sake of AI because it's trendy and it's cool, but really to ask ourselves, what are the key things in our platform that we know have the biggest impact on small businesses? And can we use AI to make those features better, more effective? And can we remove the burden to some degree from the average small business owner to go figure out AI and build trust that if they use our tool or other tools out there that they might find helpful, that all of us at the industry where we have the resources and the time and the energy, we're figuring the AI piece out and we're using it to make what we do better and better. So those are I could talk about this for a long time, but those are my initial thoughts. Thank you.
Thanks, Carissa. And I'll remember this, being deeply human in the age of AI, I think, and having a very targeted strategy on AI, what it solves. Yeah. So very insightful. Thanks for sharing that. And I do want to bring you, Hussein. I think the AI, more from a emerging markets perspective, I think it's still evolving in your markets. And how do you see the role of a development bank, especially when it comes to AI and building on what Carissa mentioned?
Well, I think I'm very much aligned with what she was highlighting. I think for us, it's AI is supposed to help us to speed the decision making, not to replace accountability. And I think I'm also lucky from my side. I'm in the growth mode at the bank. So we're using AI without letting people go. Okay, so using AI for the efficiency from the back end. We cannot replace the human touch. I'm sure Kamar and many of you know the nature of the culture in Oman. It's more people driven, not the robot driven. So what it's more, we decided to implement AI at the back end, not at the front line. The front line we are now what we are doing. We have many people who are working at the back office. We are developing their soft skills and some kind of development to bring them in the front end. But our role as a bank, still, to be honest, Kamar, we do not have the in-house capacity to understand lending to the AI models entities, right? Uh, Banks in Oman are cash flow driven lending. They are not value appreciation driven lending. So, we don't have any bridge finance model, or, where we don't have a model we can lend to an entity who will be, the value of the entity will grow faster after few years based on the data they have, whatever. We are cash flow lending. So we couldn't do, and not only us as a development bank in Oman. I don't know even a single commercial bank in Oman is going to lend to AI. Yes, all of us, I think, started leveraging on AI as much as possible on the whatever as the quick wins, okay, especially when there is accurate data is available. So we use the AI in a proper way for enhancing the in-house efficiency. But Oman is yet to use AI much, going to make it as a customer driven. It's not we are slow, we are advanced, we are a deep pocket, we have enough infrastructure, time, energy, money to invest on it. But I think the culture itself in Oman is yet to adopt that much. So we may want to be as a hub for data mining, for building the AI infrastructure, invite the FDIs to come in and use Oman's infrastructure, the energy availability on an affordable basis to build the AI hub. But in-house, we are very limited to utilize the AI, and the intention is to add the efficiency but keep the accountability.
Thanks, Hussein. And very interesting view on value appreciation model versus cash flow lending model. So I think I would love to kind of delve deeper into that, and also the role of culture. AI is not just about putting a machine learning in place, but more about adapting to culture as well. So thanks, Hussein, for sharing the insights. And Philippe, I do want to bring you in. I think there's a lot of talk about responsible use of AI, and I think especially in the segments you operate. So what are your thoughts on this topic?
Okay, actually, my thoughts are kind of similar to what the colleague from Oman just mentioned. So, what we do at Baobab, we mostly implement AI more for back office type of work. I mentioned that we do quite a bit of credit scoring on customer data to take credit decisions, and it works fine. But we're not really deploying AI yet. I mean, AI in the new sense. I mean, every AI is basically a different form of scoring, but we use more traditional scoring. But for AI, we deployed agent. So we built our own agent, which answers to queries, for example, from loan officers. Tell me about the credit history of that customer and so on. And it's really in the form of a chatbot, but which is essentially like a very sophisticated back office tool in a way. What we're also thinking about very hard is the whole question of AI governance, and where do we put the guardrails, and how do what framework we put around it, and I think that is something very important. Then there's the question of risk management. when you start using AI, it should not be some kind of black box. Nobody develops their own models. Everybody, I mean, in the financial sector just uses models which are developed somewhere else, these so-called foundational models, which are either from Google or Anthropic or someone else. And as long as we don't know completely how these models function, it's very important to put some guardrails and some kind of governance and risk mitigation measures in place. So generally speaking, it's very important that everybody just understands what's going on, starts to experiment with it. But at the same time, as a financial institution, we need to be also cautious. So I think that the human element is still incredibly important. And I'm coming back to what I said at the very beginning. We operate in, at least Baobab, in extremely informal markets where the data footprint about our customers is really minimal sometimes because they operate purely locally. It's very much cash-based. And then the human element is incredibly important. So it comes back to the human element. So AI is definitely not going to replace the employees at Baobab, but it will be more like a tool that helps them for certain specific tasks. That's how I see it in near term. Then longer term, let's see.
Thank you, Philippe, and again for endorsing that it is a tool, not a replacement for humans and staff. And I think again endorsement of how AI can be used in back office and also how AI governance is very important, especially under foundational model structures. And I also would like to bring you in, Wagner. I think I'd like to bring just final quick thoughts from yourself, Wagner and Oman, on how you see AI evolving. Just quick comments before we close off. It's an important topic. I'd like to hear from you.
I think that we've covered most of the AI utilization so far. I think that the fraud detection is something that it's very, very useful as well, using AI to try to find, let's say, more information and to confirm more information. The risk here is that as we don't know exactly how the models will search this information, we might end up in a situation that actually it helps the fraud itself, not the detection. So it's something that we should be aware of as well. And I totally agree that we should consider AI as a tool, not something that could be replacing the decision-making or replacing even some of the let's say, creative jobs that we need to do here in creating products and creating solutions for SMEs.
Thank you, Wagner. An important point, using AI for fraud detection as a key element. And Numan, I think your perspective on AI and any insights you have on how it's
Kamal, I think for a market like Pakistan, I think I mean, obviously AI has permeated every country, every market, and it's as someone said, it's the elephant in the room. And everyone's talking about it, and there are really unrealistic expectations of AI as well. I mean, everyone's using ChatGPT and various platforms for for access of information. I think in Pakistan, the problem is data availability and also the data quality. In some ways, I think it's there because the government has invested a lot in the IT infrastructure, like NADRA and so on and so forth, in terms of basic information on population and, each individual, each citizen and things like that. But from a financing perspective, from a commercial banks or financial sector perspective, the main challenge is that a lot of these financial institutions have data. They have had data for a long period of time, but they have really not been able to use that data intelligently, mine that data intelligently into something actionable. So that is, I think, the major challenge with the permeation of and automation throughout the economy in terms of 5G and also 5G enabled phones and the IT infrastructure is being upgraded very quickly. But I think what is lacking is how do you basically leverage the data that you already have available, not only in terms of whether within a certain bank or financial institution, but as a sector as a whole. So I think that's where that's where the central bank comes in. That's where it requires a lot of development of a clear, focused thought process in terms of how we can leverage this data. So I think AI is going to be very very important, and I think it's going to play a critical role. But I think the major challenge is the underlying data and how useful and how do you basically use it in a way so as to to help financing SMEs. I think that remains the challenge, and I think the main thing is that the data is already available within the system. I mean, within the financial sector or from other bodies or whatever. How do you basically mine it, collect it to so then basically do use for actionable transactions or initiatives?
Thank you, Naman, for I think sharing very important insight. As good as the data it feeds. Also, I think really the importance of ecosystem to make sure that you have the right tools in place. And I see some questions on fraud, also scams, and also the bias. So we do plan to, Sarah is our digital innovation hub lead. We do plan to organize a session on these topics under our innovation hub. So we look forward to taking the discussion forward. We are unfortunately on time. So I wish we could have taken these questions, but we will address these questions under our different innovation hubs. So with that, I think I would like to thank all of the speakers, the participants who have, everyone has almost stayed online throughout the discussion. So that's hats off to all the speakers who have been on the call today. And Susie apologized. Her connectivity was an issue, so she apologized for not being able to rejoin. But I think we will organize different discussions if you'd like to have more details on her. On her company and the work. But for now, I would like to close today's session by thanking all the speakers. Wagner, thank you for joining. Carissa, thank you for your input. Susan, Philippe, and finally Numan. Thank you so much for joining today's session, for being valued members, and the discussion is only starting. And we look forward to your collaboration going forward as well. And thank you to SME Finance Forum team for putting this together. Thank you everyone for joining.
Thank you very much. See you.
Thank you.